Hello everyone, this is Marios Hadjikyriakos, investment analyst at XM, and today we are going to be looking at the upcoming US employment report for February. So let's start by saying that the labor market is by far the brightest spot in the US economy. Jobs growth has remained robust in recent months, even though the broader economy has slowed and inflation has cooled. So strong, in fact, that wage growth is finally starting to accelerate, which is very important because it implies a stronger consumer and therefore stronger inflation moving forward. According to forecasts, this week's numbers are expected to confirm this positive outlook. Non-farm payrolls are expected at a solid 180k, the unemployment rate is projected to decline, and wages are anticipated to have accelerated further, all of which is good news. Markets will probably focus mainly on earnings. This is because the Fed has made it clear it wants to see inflation move higher before it raises rates again, and since wages are considered an early indicator of inflation, they tend to attract the most attention. Looking at market pricing, investors actually expect the Fed to remain on hold throughout the year, mainly because they don't see a strong case for either a rate hike or a rate cut for now. Therefore, a strong set of jobs data this week, especially on the wages front, could make markets a little more confident that a hike could take place later in the year and thereby help the dollar to extend its recent gains. However, any disappointment could see whispers for a rate cut return and by extent hurt the US currency. Now let's zoom out and look at the overall picture for the dollar. The reserve currency has been gaining lately, and even though it could still move a little higher in the near term, some caution is warranted. The dollar is now very close to levels it has repeatedly been unable to break in recent months. So for example, whenever euro-dollar has approached the 112.50 zone, it has encountered strong buying interest, something that is owed to the spread between US and EU bond yields narrowing as is shown on this graph. In other words, relative interest rates are now providing support for euro-dollar, which implies that for a break below the November lows at 112.13, for instance, some strong catalyst may be needed. So that's it from me. Thank you very much for watching and have a great day.